I think it's been more than a month since I sat in this chair. Um, Bill, I think we're the two of us together. We've had a lot that has occurred in the markets this year, as everybody knows. We've had a lot going on. There's more to share about that in the future. But I've been out of town. I was out of town 3 weekends in a row. Mountains of North Carolina, trout and redfish fishing with Bill and Corpus Christi, and a trip with my bride to Dallas. And it seems like we finally
Did you mention that I caught the biggest fish?
no,
There you
no,
go.
but Bill caught what looked to be about a 7 or 8 pound 28-inch redfish. That was amazing. And I'm getting they had a freeze come through there in 2018, was it, Bill? And they made it so that the limit sizes are larger now. So we were interested in black drum, over 15 inches they have to be. And that's probably a 3 or 4 pound fish right there. We brought back 25 of those. I caught the biggest black drum. Of course, Bill's redfish was bigger. The redfish had to be over 20 inches. And unfortunately, we went night fishing, and I caught three between 18 and a half and 19 and a half inches and had to throw them all back. Those are large fish. And then Bill landed the lunker, 28-inch. My brother caught a nice flounder, and we limited out on trout. And a speckled trout, delicious eating, they have to be 17 inches or more. So we were fishing till 2:30 in the morning. The lights come up from the canal and form a little circle, and you can see the fish eating shad or whatever, in the circle. So there's too much information, but Bill caught the largest fish of the weekend. Now we've had this. We're leaving here today for Memorial Day weekend on a long weekend. Everybody, I think, is feeling a little bit better about the stock and bond markets this week, Bill. We've really had something historic that ended last week. The Dow Jones Industrial Average having declined 8 weeks in a row. That is the longest streak in over 90 years. And so we've actually got the Russell 2000 small cap index and NASDAQ composite have entered into bear markets, which we would define as a 20% decline from the previous high or more. I'm not sure where the Russell is on those numbers. I didn't look that up, but we've had a tech wreck. And we've actually positioned our clients probably a year ago to take advantage of what we thought was a major sell-off forthcoming in low dividend yielding tech stocks, and and that has come to pass. So there's been a huge rotation from growth to value. I looked at the Vanguard growth ETF, closed yesterday down 26.2%. That's mostly NASDAQ names or the highest 250 PEs. And the value ETF is only down 2.8. So we had stock and bond markets were down about roughly 5% in the first quarter. And then the bond market declined another 5% in April, and the S&P declined about another 9% during April. And so we're actually going to finish out. Let's see. This is the last trading day of the month, is it not? 27th. I think that's right, because Monday's a holiday. 28, 29, 30. Yeah. So.
You're going to make me look.
Yeah, is the 31st, is the what day is the 30th?
No, actually, the last day of this month is Tuesday.
Oh, it is Tuesday. The 31st is Tuesday. So we will, if the market can continue its strong activity that we're seeing right now today and this week, May still down just a smidgen, but we've had a very powerful week, and so what this
Yeah, we were
tech,
up.
huh?
We'll be up, what, about 6% for the week?
Probably something like that. Yeah. So I think what's caused all this volatility and sell off in your view, Bill?
Well, before I even attempt to answer that, I'll say this: it's human nature that people crave certainty, and investors are no different. So I think people are very susceptible to overly simplistic storytelling narratives. So that's my disclaimer. But sometimes markets are just vulnerable to good news.
Yeah.
Right. And there's been so much pessimism, so much, not just with excuse me, asset price pessimism, but economic pessimism, that any little bit of good news can be the impetus for some kind of market rally, and maybe just people were just tired of all the selling. Who knows?
Well, we could have run out of sellers. I think to just to take a stab at that, we had the it's these inflation numbers, excuse me, that started rattling everybody. And if you look at this, we'll be getting the May numbers here in 2 weeks, but the April CPI print was 8.3% year over year. Now the prior month was 8.5%, but the producer price index number was 11.0. So if you add those two together, that's 19.3 divided by 2. You could say that inflation is running about 9.65% right now. Incidentally, that's
on a year-over-year basis.
That's what I bonds are paying right now. Anyway,
but I mean, the inflation picture probably does factor in to this recovery rally that we've seen playing out this week, because there are indicators that people are looking to justify saying that inflation on a month-over-month basis appears to be moderating.
I don't think we'll see a drop off in May.
Well, whether we do or we don't, it does seem that is a consensus view, that we are moderating on a month-over-month basis. And we know that the Fed's been battling this pretty hard, at least talking about it, in addition to taking monetary policy action. And we have seen financial conditions tighten as a result of Fed action. And I go back also to what Jerome Powell said earlier this month, and I quote, "What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that. We clearly have still a job to do when it comes to cooling down demand." So that is what the Fed is battling at this moment, and we'll see. We'll see.
Yeah, I mean, I would counter that. There were numbers that just came out today that the Fed purchased 175 billion in U.S. Treasuries in March, and this is after they've had all these hawkish remarks about the tightening that they're going to be doing and the unwinding of the balance sheet. And I would give what they've said about policy decisions for the rest of the year, I would give that a near 0% probability of actually coming to pass. And
that's a pretty bold comment.
I don't think so.
A 0% probability.
Yeah, if you go back and look at Bernanke and Yellen and their policies, they were all derailed from their intent to get rid of the balance sheet and I mean, the historical pattern since the subprime crisis is that they speak hawkishly, and then when trouble comes, their plans get interrupted, and they go right back to quantitative easing. Same thing
Yeah,
with
I guess the difference between then and now is that now we have high inflation, which we didn't have during those 10 years of the other Fed chairmen you mentioned.
so that's exactly right. So that's what's made this. We talked about this on another episode, Bill, is that since World War II, there have been 13 tightening cycles, and 10 of those ended in recession. And the mean time to recession from the first tightening was about 25 months. And in two of those 10 instances of hard landings, recession came within 10 months. So, 10 out of 13, that's a 77% probability based on history dating back to World War II that at some point in the next 2 years, we'll see a recession. And I think about this, Bill. Here's an interesting statistic: is I think the fragility, perhaps, of the American consumer, and with these inflationary numbers, I heard recently either 63 or 64% of Americans today, and I think you could plug in Europe is probably worse. They live paycheck to paycheck. Now imagine living paycheck to paycheck, and your grocery bill and gasoline bills are up, 40%
Mm-hmm.
from a year ago, something like that. So what we started to see, which the markets I think sold off on this, is we've started to see cracks in subprime lending, like people with poor credit that are buying houses and cars, credit card debt, things like that. We're seeing an escalation in people that are 60 days late or more. So the big question is, because I heard these talking heads on here today saying, well, it's looking like we're not headed for a recession. Everything's fine, and the markets are back on track again. Like this thing is over with now.
Well, maybe you should listen to some other talking heads.
Okay. Oh no, I mean I just turned on the volume today, and that's what they were saying.
That's why we tell people turn off the news.
I'm going to tell you what they do is if I ran Fox Business and wanted more viewers, on down days I'd have the most pessimistic guys talking,
Yeah.
and on up days you find the most optimistic guys talking. That's why it seems like when the market starts off strong in the morning, it's stronger by the close.
Well, and that's just like the old saying: things are never as good as they seem, nor are things ever as bad as they seem. So, yes, I mean, we could very easily go into recession in the next 2 years for the simple reason that the Fed is tightening, and historically the Fed takes this too far in either direction. So tightening financial conditions can spur recession, absolutely. But we don't want to be so myopically focused on whether this plays out or not and miss out on investment opportunities, because at the end of the day, we need to get returns on our money and not focus on accuracy and predicting economic forecasts.
And I thought it was kind of something interesting to me to maybe kind of talk around a few simple questions. Why have we had this sell off, which we've covered a little bit? Why did we have a strong week this week? And what can we do about this, or what do we like, or what should we be doing? And one of the things we should not be doing is panic selling.
Absolutely.
Which we have seen, but I think one of the biggest things that we haven't talked about today, we have previously this year, is why the sell-off. I think that we got into a market seemingly last year that got too easy. And when you have the market going up almost every week and almost every month, it draws in a lot of speculators. And I think especially young people that think they can do it yourself. And a lot of these people opened up Robinhood accounts and bought crypto through there. And I think the majority of the accounts at Robinhood used leverage. So then, you own the most volatile tech stocks and cryptos, and the market, falls 20%, excuse me, or more, or 30 or 40%, and you're over levered and start to get margin calls. And then you have forced selling amongst the speculators. And I think that we've seen a lot of that, and to some extent, I think, Bill, that by the time we got to Monday, a lot of these sellers, we ran out of sellers in some ways. Some of the speculative sellers. So I'm not in the camp that thinks that, although the GDP number came out today and quarter over quarter, it was negative, and GDP for the last quarter was negative. So when we see, if Q2 comes out negative, I mean, for a lot of people's definition of a recession is 2 declining quarters in a row. And that wouldn't be that much of a stretch. But the CBO is looking for GDP growth in America to be something like 3.2% this year. And if you look at annual GDP growth for the last 20 years in this nation, I mean, that would be, you could really call that robust. So, and I think a lot of that is because we've had a lot of stimulus, which has brought about, too much spending chasing too few goods as well. So, do you add to that?
Where do I begin? I think that in this environment, just like I said earlier, that investors gravitate towards narratives in times of uncertainty because they're looking for certainty. I think similarly that people are looking to historical playbooks to apply to their investment strategy. And there are some things that are very unique to this environment that we're in. For example, I think the consensus view is that we are late cycle, perhaps heading into recession, and yet we're seeing certain cyclical sectors doing very well. We're seeing travel boosting, airline stocks are doing well, relatively well, and they're reporting
This week.
Yeah. I mean, airlines are reporting strong revenues and bookings. I saw something this week about the average age of U.S. vehicles hitting an all-time high of 12.2 years, which implies pent-up demand for future purchases. Well, those are cyclical purchases. These are economically sensitive companies, automakers and airlines and other companies like that. But we have to keep in mind, I mean, we're coming off of an economic lockdown. So we have a lot of things going on under the surface that can really muddy the water for us in understanding where we really are in an economic or business cycle. I don't think it's as easy as perhaps what it's been in the past and as far as applying playbooks to how to invest.
Yeah, I mean, our playbook though was have some inflation protection in our portfolios, and not too much, technology and growth stocks. So, and I think this huge divergence that we've had there is likely going to continue between growth and value. And I think one area that we have avoided too are long dated bonds. and that, that appears to me, I think that, this inflation problem, which looks like, I think it's likely that the inflation could moderate a little bit, but I think there's another near 0% probability is that inflation gets back to where the CBO and um, government officials and the Fed think it's going to be by year end, or next year. And I think with that, some of the biggest opportunities would be to take advantage of that. Might also point out that, consensuses are almost never correct, Bill. And so if you want to make the most amount of money, you have to have a contrarian stance. Now that also requires that you have to be right. So, but I mean, I'm seeing like hearing talk that this inflation thing doesn't look so bad or it's getting a little bit better. Well, I mean, I look at today's Wall Street Journal and the Dow Jones Commodity Index. I don't think it's ever been higher. It's up 30% this year, and all those things are going to be showing up in the May. May's almost over. In the May,
Would you say that high inflation is a consensus view?
I'd say the opposite is. Say the opposite of that. That's why I think there's still opportunity in things. Some of the things, and I'd like to point this out. If any of our viewers, I was told by a client today or this week that he has several advisors, and his family accounts with us had done far better than any of the others. And I would articulate that the reason why, we've owned very short-term baby bonds, investment grade, yielding 6 to 7%.
But this is not a testimonial.
Yeah. Not a testimonial, whatever that means. But we own algorithm run 40 Act funds, or i.e. open-end mutual funds that we own 3 different ones that have appreciated anywhere from 13 to 21% this year. And I mean, one of them is up like 21% year to date. And I actually think that those things are going to keep on going this year, Bill. So I think, when we say what do we like, I mean, we want to speak generally and not name individual names or, give away our secret sauce or anything like that. But generally speaking, I think the first thing is we don't have all the answers, and we don't know. I don't think that this sell-off that we've seen in the first 4 months, though, I think the bulk of this is likely over. Certainly the world's is coming to an end. I mean, we're not heading into some kind of horrific recessionary period, at least not, this year. So we still like that which is scarce, which is above market dividend yields, very low valuations, and things that give us, inflation protection. So I don't know. Does that answer?
What was the question?
I don't remember.
I don't either.
What's your favorite ice cream?
Thank you, Wesley.
What's your favorite ice cream?
That was the question.
But you just mentioned something which is going to make me take another look at, like the auto supply companies like AutoZone. I think that I read the same article that the average age of vehicles on the road is something like 12.2 years. I think it's
12.2.
I think it's higher for like trucks.
Mm-hmm.
And I could see that number even escalating from here. I think partly, I mean things that were manufactured 10 or 15 years ago are much better pieces of equipment or automobiles than they were 30 years ago. I mean, I think like some of these Japanese vehicles that go 300,000 or 400,000 miles, and even GM makes, vehicles like that in America. But I think if 64% of Americans are living paycheck to paycheck, and they've seen their groceries and gasoline bills skyrocket, they're likely going to hang on to their
Mhm.
automobiles rather than buy a new one.
Well,
And
they may not have a choice because of things like chip shortages.
that's another factor. So you can't even, if I haven't tried, but I wonder what it's like. I drive down by the auto mall and I see hardly any new cars
No,
out
I
there.
can tell you, my youngest daughter, and hats off to her, she's graduating high school tonight. She has a new car on order, and it will end up being a 2 month waiting period for delivery of this vehicle.
Oh, okay. Okay. Um, Interesting. Is it a gasoline powered automobile?
Oh yes,
Oh yes.
It runs off of hopes and dreams.
I do want her to get from point A to point B without having to stop and charge somewhere. So yes, it's powered by good U.S. gasoline.
I read I think it was today's local Shreveport Times. There's a competition amongst Tesla drivers at how many different filling stations they could go to, charging stations they could go to. Anyway, most charging stations is
Look, I don't, and let me just say this in full disclosure, I don't have anything, against battery powered vehicles, and I
Every vehicle has a battery.
thank you, Wesley. Every vehicle has a battery.
What I'm
Yes.
here for.
Further,
Facts.
but just as a matter of practicality, if I were to drive from Shreveport to, let's say, New Orleans, I couldn't do it on a full battery charge. It wouldn't make it. And
my truck will go that far.
well,
You've
you
got
don't have
one of those kind of
a
wimpy trucks,
but you don't have a battery powered truck. That's my
Oh,
point.
okay.
If
Yeah.
I had a battery powered car, I couldn't make the trip on a full charge. And it would take, I believe, 20 to 30 minutes waiting to charge up the battery.
I thought it was closer to an hour.
Well, you know what?
And
But you could be
and-
right on that. And, who wants to do that?
Yeah.
Have you ever gone to a gas station on a road trip? That's 20 to 30 minutes every time.
It depends on what you do at the gas station.
No. I
If
mean,
it's a Boosie's, you go inside.
it takes 5 or 10 minutes to fill that sucker up, and
5
then
to 10 minutes to find your credit card first.
He's got a point.
Yeah, no, I actually think that these high, if it's by design to intentionally have high gasoline prices so that we go more green,
Well,
I mean that will work. It's going to take a long time.
If I'm
though.
spending more than 5 minutes at a refueling station, it's because I'm stopped at Buc-ee's. That's it.
That's good, Bill. Well, I think we've kind of, just kind of hit on what's going on with the market. I felt like it was very important, even though we missed having a Jack and Bill show last Friday. We've had very volatile markets, but I think, given the level that we're at right now, there are opportunities in this market, especially adding to positions, putting money to work on any kind of weakness, especially from here, because we're looking at a NASDAQ market that's down 27%. I'm still not crazy about that, but I do think some of these names have been perhaps punished more than they should. For example, Apple, Amazon, some of the really, I mean, they've got to go up as much as 50% to get back to where they were. And these are quality. So S&P 500 was down 15.4% from its all-time high, which was made January the 3rd of this year. And the Dow industrial stocks, which when we started the year, we liked them more
Sure.
than the S&P, which we like more than the NASDAQ. It's down 11.3% through yesterday's close from its high. So we've got, and the bond market, Bill, if you've got, I bought a 90-day CD for somebody yesterday that pays a monthly income and yields 0.95%. Now in December, that CD would have paid 0.1.
Yeah, 2-year CDs are yielding 3%.
Yeah, so we can get 3% on 2-year CD, and that's kind of the area of the curve that I will throw one kind of forecasting kind of comment out there. I think I've already kind of said this, Bill.
Just one?
I think that it's a near zero probability that the Fed is able to bring their plan to execute their plan
This
for the
is
full.
actually your third
For the
near
full year.
0%
Okay.
probability
Well,
forecast.
That's just a reiteration of what I said. So I think that at some point in time, and that is what in my view, and here I'm going to reiterate something that Goldman Sachs strategic economist said, which I happen to agree with, because that's what they've done every time. If the Fed has a dual mandate of full employment and stable prices, and we, as you indicated and pointed out earlier, we haven't had a problem until recently
Correct.
with the stable prices. But I believe if it looks like we're headed for a recession, especially coming into the November elections, I think that you could see the Fed drop all plans for unwinding the balance sheet and tightening the Fed funds rate, and actually reverse course and go in the other direction.
And you know what? In defense of the Fed, would that be the wrong policy course of action? Because can the Fed do anything about gasoline prices? No. Can the Fed do anything about food prices? No. They can't do anything about those.
Well, there's another side to that. Well, first off, they can't do anything about the food prices, in my view. Maybe luxury food prices.
Well, they can't do anything to directly affect food and
Okay.
energy prices.
Well, if they tighten 0.5% every single time they meet, eventually they're going to put us into a recession, and people aren't going to be driving around as much as they had, and gasoline prices would fall. So there's another side to that story, and maybe people would stop eating out, But generally, I think you're absolutely correct. There's not much the Fed can do about commodity price inflation and supply chain disruptions.
The indirect effect of Fed policy on things like food and energy is demand driven.
Yeah.
And the issues that we're seeing are supply driven. And certainly the Fed can't do anything about those. Hey, I'll throw this out, because everyone gets all worked up when markets are correcting. But it's important to remember that volatility is a feature of financial markets. It's not a bug. Nothing's broken. The financial markets are working. And we need volatility. It's healthy because things can get out of whack. If we didn't have corrections, we would just be in a constant state of bubbles. And we would see things going up in price for no reason. So we do need this. It's very healthy. And with volatility and corrections, we do get presented with fresh investments. So we can find things that are now priced at levels that can provide higher rates of return in the future. So it's good, not bad.
Yeah, I read, to go along with that, I read a weekly commentary from a bond fund manager that we own and like. And he said they wouldn't be able to outperform if they didn't have volatility and the opportunities that come about with that volatility. And I would like to reiterate, while I think that the most mispriced securities in the market are long dated bonds, I can't see long-term interest rates coming down. That's very hard for me to see, recession or no recession. We do like short-term bonds out to, 3 or 4 years. And if the Fed gets derailed from their policies, from their tightening policy to thwart inflation because recession is looming, you will see bonds in the 5 years and under, I think, perform tremendously well. And that's the thing we had, Bill, before when the Fed did something. Some people think this is stupid, but you articulate how you're going to combat this thing, and then the market makes a violent adjustment and does it for you before you have to raise your finger.
Yes.
And that's kind of what happened.
That's called Fed forward guidance. So they can talk the markets into doing what they plan on doing with their actual actions.
And that could be intentional.
Oh, it is intentional.
Yeah. So, well, I think, what else did you want to cover, William?
Nothing. It's a nice long weekend. We're celebrating Memorial Day on Monday. So while you're wolfing down hot dogs and doing whatever you're doing, remember that we're able to do this show because of sacrifices made by men and women for our country.
That's good. Thank you for pointing that out. Thank you for your service, man.
Thank you for your service. And for all those out there, thank you for your service.
Yes, and go watch the what's the name of the movie?
Top Gun Maverick.
Top Gun Maverick. I'm going to check it out this weekend. I heard it's
great.
Terrific. Great reviews. Peace out. Have a great weekend. Be safe.